Now in today's video, we are going to be talking about why it might be beneficial not to invest in the stock market right now. So I hope you guys enjoy it. If you guys get anything in value out of this video, hit that like button, subscribe to the channel. If you have any questions, let me know down in the comments. And if you want to learn more about investing, money management, trading, we do have a course that offers a whole bunch of fantastic videos, quizzes. On top of that, you'll have access to the chat room. And this is all for less than a cup of coffee. So make sure you guys click that link down in the description. So now let's jump into the video. Now right now the S&P 500 is down about 24%, and really there's two options that you can look at this. The very first option is, okay, right now the market's down 24%. I'm gonna buy in. I'm gonna try to get in on some more affordable pricing just because this represents a great opportunity to buy stocks that are on sale. The second option is, oh my gosh, the S&P 500 is down 24%. I'm not gonna touch this thing. This is a sinking ship and I should stay away from it. Well, right now there's a whole bunch of key indicators that are saying that the crash could be still coming. Now we're going to be covering some of the reasons why some of these top analysts expect that the S&P 500 could fall another 20%. So the very first reason right now is we have very, very high rates. We have high rates, we have high interest rates, and anytime we have high interest rates, spending kind of comes to a halt. The reason why is because it's very expensive to take out loans. Right now, if you wanted to go out and buy a new house, you're looking at a rate of about 6%. And the craziest thing is less than a year and a half ago, a rate was rated about 2%. So you can see in a matter of just about a year and a half, rates have doubled, if not more. Now, right now, a house that is worth $500,000 has the same monthly payment as a house that was worth $350,000 a year and a half ago. So people just have that mindset of, okay, I'm just gonna wait for rates to get lower, which is one reason why the market is continuing to fall down, because people aren't spending. And this is the same thing with cars. Used cars right now are coming to a screeching halt, as well as new cars. Cars in general, the reason why rates are getting very, very high. Now the second thing we haven't seen since 1949, which is crazy, and this is the general bond market at a steady decline. The last time we saw this was in 1949, and every time we've seen a steady decline in the bond market, this represents an upcoming crash. So a lot of world-class investors and even retail investors are seeing this coming in and they're not investing, which is making the general stock market continuing to sell off. This is one of the main reasons why we've seen in the past 5 days just a steady decline off the S&P 500 is due to the bond market. Now the third thing is inflation. Historically, inflation is always rated about anywhere from 1.5% to 2.5%. On average, that is rated for a healthy economy. Right now, the inflation rate is at 9%, which is very, very, very high, meaning you do not have the same spending power that you used to. Anytime we have high inflation, virtually everything becomes more expensive. Gas becomes more expensive, homes become more expensive, cars become more expensive, groceries become more expensive. On top of that, if you have high interest rates, you have very, very expensive homes and you have very, very high rates, which often causes for a screeching halt in buying pressure just because no one wants to buy things that are expensive and having high rates. Now the fourth and final thing I want to talk about is right now the S&P 500 is down about 24%. And a lot of people are saying, okay Carter, this thing is going to get some buying pressure, we're going to get pushed back up. Well, looking back at previous history, the average bear market lasts for about 14 months. Right now, we're only about 8 months into this storm, so technically we still have several more months, if not a year, before this recession passes. So answering that question of should you buy stocks, personally, I definitely think it's always a smart option to invest, but maybe in the next upcoming months, wait. You don't have to invest and you always can continue to invest. But a good strategy that I always recommend, especially for beginners that are worried about upcoming crashes, recessions, is a strategy called dollar cost averaging. Pretty much what you do is you invest on a weekly basis, maybe $10 a week, $20 a week, $100 a week, whatever you guys want to invest. And anytime the S&P 500 falls another 6%, double what you normally will put in. So if you normally put in $100, the S&P 500 falls, that 6%. Now put $200 into this. The reason why is because through all the ups and downs, through all the bull and bear markets, recessions, Great Depressions, the S&P 500 has had an annual return rate of about 10%. So if you just have a long-term outlook on your investments, this is going to be very, very good, because you're going to be doing the best thing you can do is buying at these lows. And anytime you buy at those lows, historically you have a 22% higher return than somebody that does not. So the biggest thing, yes, continue to invest, but understand that a crash could be coming, and who knows, right? The biggest thing, I don't know. I'm just giving you guys some information on why and how it could happen. So guys, I hope you guys enjoyed it. If you did, hit that like button, subscribe, and we'll see you guys later. Remember to stay happy, stay positive, and stay safe. Take care, everyone.